Hey, this is Mike Durr, the Kingwood Mortgage Guy, and we are going to talk about credit tonight. This is really for people that have less than perfect credit, but you still want to buy a house. And you know, it's a really good time to be buying a house right now. We're in 2016. It's February 23rd. It's 7 o'clock, and we're getting ready to start off on this. And really, I want you to feel free to ask questions. Or this is what we're going to do. We're going to get you to put your questions in the chat. And what I'm going to do is I'm going to answer them at the end after I go through my slides. So again, my name is Mike Durr. I am the Kingwood Mortgage Guy. This date is wrong. That's okay. But my number's right, 281-348-9899. And again, I am currently with Nations Reliable Lending. So what is credit scoring? Well, the credit scoring is the use of statistical risk assessment model, which allows the creditors to use a consumer reporting agency information to significantly increase the level of their predictive power to determine good payers and bad payers. And when you can decide, or when you can have a better idea on who's going to pay you back, then it becomes a little bit easier to lend money. And of course, they use the credit scoring mechanism for, gosh, it's been 15, 20 years that they've been doing this. Actually, probably 15 to 16 years that they've been using this scoring mechanism. It has progressively gotten better. And what they're doing is they're predicting who is likely to not pay them over a 90-day period. And so when you have a higher FICO score, the creditors will believe, and probably correctly so, that they're a better chance of getting their money back. And then as you go down this chart, the credit scores are lower. This whole system is based on how they're going to pay unsecured debt. Now I'm going to go into that a little bit more about unsecured debt versus secured debt, but it's important for you to know there's a big difference, and the scoring mechanism is heavily slanted towards unsecured debt. So, and it's done that way to protect the people that are the ones that were the strongest proponents of bringing a scoring mechanism or a scoring system into play. So I'll get a little bit more. Let's see. So old school scoring. I actually, when I started in this business, we used to score people differently, and I love this old school, where people are holding their hands or dancing around the schoolhouse. I guess you don't see that much these days, but you don't see scoring the way we did. It was a little bit more tedious. It took a little more time. We broke the scoring down by category: secured debts, credit card debts, mortgage debt, or rent debt. And one of these days, tonight's not tonight, I'll tell you all about that. But it was different, and we didn't see why they wanted to do credit scoring, but I see it today. Credit cards are unsecured. This is unsecured debt, and they're going to play a key component in you being able to get your credit scores back up. Now, I'm going to tell you that I am a huge Dave Ramsey fan. I think Dave Ramsey is the bomb. And Dave Ramsey makes a serious practice about cutting up cards, telling you to never get credit cards, not to do anything with credit cards. And I will tell you that in many levels, he's right. I mean, credit cards can be dangerous. They can lead you to spend money that you wouldn't normally spend if you're spending cash. So I'm going to share this little story. Credit cards are really a tool, and my example of that is that when my family sees me with a hammer, they get very concerned that I have this hammer because they know something's probably going to get broken. And so the tool is all about how you use it. You put that same tool or the hammer in the hand of a carpenter, and he can build and make beautiful things. You put it in somebody that doesn't know how to use it, and you could have a real mess. So that is my analogy for credit cards. So what I'm going to do is I'm going to tell you tonight how to master this tool that can be very dangerous, but it also can be very helpful if you use it correctly. Okay, so that's what we're here for. That's what we're going to talk about. All right, scores are dynamic. This is something a lot of people don't understand. They think once that their credit score is bad, it's bad forever. And actually, the credit scores can change within a day. Just depends on what's being reported on them and who has reported to the credit reporting agencies. So it's very important that you understand that, and that's why we're able to change credit scores pretty darn fast. This is a boring screen, but the score represents whether you, I'm not even going to talk about that one. Each bureau's scores are different. A lot of people don't understand why we have three, actually we have more than three bureaus. But the three main ones, Experian, Equifax, and TransUnion, they all have a little bit different model in the way that they score people's usage and the the way they look at it. So they're always going to be different. They're rarely, if ever, going to be the same. So I'm going to show you how to raise your score 40 points, and could be as fast as 2 weeks. I put 45 days because I know I can do that. I've done it faster than that. And again, Mike Durr and the real estate staff, and I do have a staff here. They're not here tonight, but we're talking about how to get your score going in this direction. And for a lot of people, they have no clue what they are needing to do. So if you stay with me tonight, you're going to learn how to do this. All right, so what makes up a credit score? Well, it's part payment history. Now think about it. If you were going to give somebody a score and they hadn't paid you, you wouldn't give them a very good score. If they did pay you, you'd think, well, I ought to have a good score. Well, in this particular case, it is a big factor, and you can see that it's 35% of the score. Now, a lot of people, you ask, well, wait a minute, why isn't it bigger percentage than 35%? Well, it's not, and I wonder that too, but that is because the people that figured out this algorithm are actually the credit card industry, and they found that just because you pay it good is not a full picture of what they need to know. So the second one, and this is the big one that we're going to mess with tonight, this represents this green block here. It's the balances carried. And the balances carried, I'm going to explain that in more detail later, but just bear with me. When I say the credit history, the credit history is really about, and that's 15%, is about the length of time that you've had credit and used credit. Now, if you do not use credit, and there are a lot of people that just don't use it, they don't like it, maybe they were taught by their grandparents to never use credit, that's not necessarily a bad thing. It's pretty easy to start using credit if you're going to buy a house or if you're going to use it, and get a credit card or get a credit score. If you've never had credit, you have nothing nothing bad report excuse me, you have nothing bad reported on your credit score ever. It's very easy to get credit. Now, it doesn't happen instantly, but it can happen within 30 days. So it's not something that you should be afraid of. Another thing that they put on there is the mix of accounts. What they want to see is they want to see a variety of accounts. They would like to see a couple credit cards. They like to see some installment debts. And of course, they obviously like to see that you're paying these as is agreed. Inquiries, I don't think it actually is 10%, even though on this chart it says that. I think it could be 10% on a younger person's file that doesn't have a very long history, but I think that the inquiry a lot of times is overblown. Seems like I answer a lot of questions about people fearful of the inquiry hurting them, and I think it's overblown, to be honest with you. I haven't seen inquiries cost more than a point or two for many people ever. Excuse me, take a drink. Okay, so payment history in the big picture, 35% bills paid as agreed. The most recent 6 months is the most important. They put the highest weight on the highest level of your credit. So in this particular case, if you have a mortgage, that's usually going to be your biggest debt. Maybe a car. I've actually had a person in here that had a couple $100,000 worth of car debt. So in his case, his car debt was his biggest. But they look aggressively at the biggest debt because they figure that's an important one. And of course, it scares them. They're very frightened when somebody misses a payment. And that doesn't necessarily mean that it has to be a $2,000 payment on a house. It could be a $15 payment on a credit card affects your credit about the same. So do not be misled that a small missed credit card payment that missed by 1 day doesn't damage your credit. It does. And for the people on this call, you may recognize that. You may have paid your debts all the time, but just recently you missed a payment for whatever reason. Right. So how many points does each thing count? Well, this is kind of interesting because TransUnion we're going to use as the example. And TransUnion score range from 309 to 839. Now, this is not inconsistent with the other credit bureaus. A lot of them go from 350 to 850, but TransUnion's 309 to 839. Obviously, if you have an 839, you have the perfect credit score. I haven't ever seen a 300 anything score. So I've seen some 400s, 500s, a lot of 500s, 600s. But what this is going to tell you is that 35%. So that means that approximately 185 points of the score is based on your payment history. So that's kind of an interesting way to look at it. It's important to make your payments on time because you have anywhere from 0 to 185 points that you can get by having a good and consistent payment history, preferably a current payment history. Now, here's an example. If when you started having credit, and let's say that you started having credit in 2010, and today it's 2016, and let's say you had bad credit, you didn't pay your credit well from 2010, 11, 12, and 13. But in 2014 and 15, you started paying your debts as you were supposed to. What I'm telling you is that the last 2 years are the most important for the credit reporting agencies. And even though you're going to have some damage from the previous bad stuff, it's going to be light. So what that tells you is that your credit can get better, and they really look at the last 2 years as the primary way to base your scores. Now this next part will blow you away. 30% or approximately 159 points is the amount owed or the debt utilization ratio on revolving debt or credit cards. Now, revolving debt, that's usually credit cards. And what they're saying here is when you have a revolving account, you usually get a limit. The limit could be $500, it could be $1,000, it could be $10,000. What they're looking at is they're looking at how much of the limit you use. Okay, so if I have let's just say I'm doing good and I have a $10,000 line of credit on my MasterCard. They look to see how I use that. Now, if I use $10,000 of that $10,000 limit or $9,999 of my utilization or of that credit card of the $10,000 limit they've given me, it scares them and they will not help my score because I did that. However, if I only use $1,000 or 10% of that $10,000, then in their eyes, I am using that card in a responsible manner, and it also is very little risk to them that I'm not going to pay. And here's why. They noticed, they did a survey, and they found that people that charged up their credit cards to the max, well over 90%, were the most likely to file bankruptcy. Now, if you don't know this, when somebody files bankruptcy, many times the secured creditors get some money back. That would be the car people, the house people, the furniture people, anything that's on an installment debt. The unsecured creditors get zero. Thus, the credit card companies get zero. They're scared to death of bankruptcy. So this is what the whole scoring mechanism is about, is trying to predict people that might be going or dangerous or at risk of going into bankruptcy. And thus the reason that this 30% is such a big deal to the credit card companies. So that is an interesting thing. A lot of people don't know that. The other part of it is this is how we use this as a tool to raise our score. And a lot of the people that I talk to that have credit cards, or maybe they don't have credit cards because they couldn't get credit cards, when they hear that, they go, huh, how about that? Well, how do I use it? And later in the webinar, we're going to talk about exactly how you get a credit card if you can't get one, and how you use it when you do get one. So we're going to brush through these others. 15% is 80 points, and that's the length of your credit history. And guess what? If you just started using credit, it's going to be less. If you have a long history, particularly a stable history of paying your credit, it's good. You'll get all those points. New credit. What they're looking for is they're looking to make sure that you're not over expanding your credit debt. So if you have a bunch of new credit, it concerns them again. And again, that's 53 points. And I really, like I said before, I don't think the inquiries are that big. So, all right. So here's an example of what I was explaining. Keep balances as low as possible. This is how you are a credit card mastery, or credit card master in this case. And here's an example. I've got a Visa card. My limit is $10,000. And I like this card. I use this card. Matter of fact, I overuse this card because it's got a lower interest rate than my other card. My other card has a $10,000 limit also, but I don't use it because it's got a higher interest. Well, and if I'm only worried about the interest, then this is probably not a bad way to go. But the problem is that I'm not utilizing this to the best of my credit scores. So what I would do is I would pay this down, or maybe even move some of the debt to the second credit card so that I would have less than 50% on both credit cards. That would help me. Now, realistically, in this particular case, it's better if I'm really worried or concerned about what my credit scores are, is I want to get this thing down to not $9,950. I want to get it down to $1,000, no more than $1,500. And this one too, I'd put some debt on here, and maybe I'd have $1,000 to $1,500 on this one too. So that means I've got to pay off $7,000, $6,000 or $7,000. So what I want you to get here is that you can manipulate these, and if it's not $1,000, maybe this is $500, and this is, if it's $250, it's the same thing. You just do not want to have much more than ever 50% on your credit card, but most of the time 10 to 20 to max 30%. And this will help you get your credit scores. So how do I use my secure card? These are some questions to improve my credit scores. So first question is, what is a secure credit card? Well, a lot of people don't even know what a secure credit card is. And if you have bad credit, nobody's maybe introduced you to this. But a secure card is where you're borrowing money that is secured by your own money. And so what you do is you go into a bank and you say, look, I'd like to get a credit card. They go, well, I'm sorry, you don't qualify because your credit sucks. Sorry about that. Your credit is low. Okay, so they go, but we do offer a secure credit card program where if you put $500 in the bank, or it could be $200. There's some online companies that do it for $200. You give them $500 that goes in a savings account. This savings account is their collateral against them giving you a credit card, which allows you to borrow up to $500. Sometimes you might have to put $550 in there, have the $500. But I mean, it's all based on the same premise, is that you're securing your own money. Now, for this, the bank, the reason the bank does this is because they're charging you interest on your own money, and they may even be charging you fees on your own money. But that's okay, because it's a minor part of what we're talking about, because we are trying to build our credit score back. So that's the premise of here. And so the next question is, my credit is bad. Why would a bank give me a secure card? Well, because it doesn't matter what your credit is, because you're not borrowing their money. You're borrowing your money. So it seems like most of the big banks don't have a secure card credit program. Some do. I think Wells does. One of the local credit unions here in town, Smart Credit Union, I think has a good program where they don't even pull your credit. You just have to make the deposit in one of their savings account, and they'll send you a MasterCard. Another question, I don't have the funds to get a secure card. Well, that's a problem. And if you don't have the funds to get a secure credit card, then you're probably not really in a place where you're going to be buying a house anyway. I mean, it doesn't take but $200 to get a secure credit card. You can get those online. So if you don't have that money, then guess what? It's probably too early for you to be talking about this. I got my card. Now, what do I do? Well, that's what we're going to talk about in the next slide, but I wanted to point out a couple things on this credit card. This is obviously a bogus John Doe credit card. If you can get one with no annual fee, it's better. It doesn't matter if you have credit or not, or it shouldn't. But here's an important thing. Reports to all 3 credit bureaus. You want this, okay? It's very important that it report to all 3 credit bureaus, and would give you, after you've had a time with them, an opportunity to upgrade to a non-secured credit card. Those would be all very positive things. So let's go on to the next slide. So here's what we're going to do. I'm going to make an assumption that you're going to get a $500 secured credit card. Okay, that's our assumption. And what I want you to do, as soon as you get that card, I want you to go spend $30 to $50. Now, a lot of times what I tell people to do is to go and take your sweetheart for a nice dinner. Or you could go fill your car up with gas. And then what I tell you now is I don't want you to use the card anymore. You're done using that card for a month probably until you get your bill. Okay, so you use it one time. You're going to spend 30 to 50 bucks on the card. This is assuming it's a $500 limit card. If it's a $200 limit card, you're going to spend somewhere between 20 and 30 bucks. If it's a $1,000 credit card, you can spend $100. Then don't use it anymore until you get the bill. Okay, you're done using the card. As soon as the bill comes in, now this is really important, as soon as the bill comes in, immediately pay all but $10. That's right, I'm telling you to leave $10 on the bill. Do not pay it to zero. Read my lips. No, I guess you can't see me. Do not pay it down to zero. Okay? Now, do the same thing next month, or as soon as you pay the bill and you know that the bill has gotten paid, then you can go and spend $30 to $50 again and wait for the bill to come so you can pay it immediately. So this is not one of those deals where you're going to be using this card a lot. You're going to use this card very lightly. This is not a card that you live out of. It is we are using this card as a tool. Remember the master's tool? We're using this card as a tool. You will see within 30 to 45 days, you'll see a real jump in your credit once you use the card in this manner. Okay, so here's a couple do not do's, okay? Do not pay this credit card late. The worst thing you could do is pay this credit card late. The next worst thing you could do is to charge this credit card for more than 50% of your limit. So if it's a $500 credit card, you never want to get even close to $250 on this bill, on this card. And you do not pay the card to zero. So I can't tell you how many times I've gone over this scenario with people. I wanted to get it on this webinar so people understand how to use these secure cards, and think that this will help you a lot. Okay? So this is Mike Durr, the Kingwood Mortgage Guy, and I'm telling you how to do this. If you want to call me, you can call me at 281-348-9899. All right, so credit history, longer credit history, higher credit score, long credit history, paid as agreed, very positive impact to your score. Never, never close credit card accounts, or particularly credit card accounts, especially if they have a long history. If you do, it'll have a negative impact on your credit score. Now, again, let's go back to Dave Ramsey. He's saying cut them all up, throw them away, don't use them, even if it's your emergency fund thing. Don't do anything like that if we're trying to build our credit score. Now, if you're trying to get completely out of debt, that is a whole different strategy. And that's not when we're trying to borrow money. That's when we're trying to get out from under debt. So that is for a different day. Dave Ramsey is for a different day. This is building your credit score up. Best chance. Ideal to have installment and revolving accounts, a mortgage loan, audit loan, 3 to 5 credit cards. More is okay too. HELOC should be greater. Here, HELOC is a home equity line of credit, and people get those. It shows up as a revolving account. A lot of times you'll borrow $40,000 or something, and it'll show a $40,000 balance. So it is negative for your credit score. And again, I'm going to say it one more time. We're only talking about getting your score up. This type of scenario, Dave Ramsey would be slapping me silly right now because I'm telling you to have a mortgage loan, an auto loan, and 3 to 5 credit cards. That is not the ideal way to live. It's not what I'm telling you to do. I'm telling you what the credit company card industry wants you to have, and that's not what we want to do. We're talking about building your credit score. That's it. I'm just kind of going overboard here. History mix, you do not want to have a short history and have a lot of credit cards. That's a negative. It's a double whammy. Short history and over 8 revolving lines of credit card is not good. All right, so I thought it'd be interesting to go over a credit report. And in this particular case, this is an old one from an old company I used to work for back in, looks like, I don't know if the date's on here, but anyway, yeah, it looks like it might have been in 07. But this guy doesn't have very good credit scores. He had some tax liens down here, and you can see he had a mortgage. Looks like he has late payments in his mortgage here. Washington Mutual Provision, this is a credit card. He has a high balance or a high limit of $9,238. He has a balance higher than his limit. Now, that's probably one of the reasons his scores aren't very good. He has an auto loan that he pays on time. And let's see, down here, he has, this is another credit card. He's got a $6,800 high balance or limit, and then he's got a 6,500, so about a 90+% usage. So again, he's using these cards all the wrong way. Here's another credit card that he's got a $7,500 limit or $7,200 limit. He's got a $6,400 balance. And then one more down here, it's a $4,800 limit and a $4,600 balance. So this is a good reason why he has 500 FICO scores. Now we're going to go to a different guy, and he has 790 FICO scores, 796, 794, 785, and you're going to see a big difference in the way he handles his credit. One, he does have a revolving credit card. It's got a $4,000 limit. He owes $137 on it. Here's another card where he's got $7,500 limit. He owes $56. It's just real easy to see higher FICO scores is really a lot about the way you use it. Of course, he does have a mortgage, a very small mortgage. Of course, he pays it as agreed, and he's very conservative with his debt. Paid as agreed, everything on there. So, shopping around. This one is about inquiries and pull multiple. I'm not going to worry with this one because we're not there yet. Soft credit pulls. This is for people that might have higher credit scores that might be worried about this. But one of the things that happens, and I think it's important to mention, is that when you get a job offer, they pull your credit. When you're applying for insurance or utilities, they pull your credit. A lot of times the credit cards, if you have a credit card, they'll do account reviews from time to time. Here's a kind of an interesting thing. You can get your own free credit report with www.annualcreditreport.com once a year from each of the bureaus. So you could actually get 3 separate credit bureaus with scores during the year, one from each bureau, TransUnion, Equifax, and Experian. So also be aware of promotional pre-approved offers that come in the mail. If you apply for those, they're going to end up pulling your credit. Blemish credit can be costly, well, big time, particularly if it's within the last 2 years. Now, the first 6 months is the worst. Low credit score, you pay a higher interest rate. So if you pay a higher interest rate on a mortgage loan, so you're talking about hundreds of thousands of dollars, $100,000, $150,000, $200,000, you pay a higher interest rate on that. It adds a lot to your monthly notes. Credit cards, same thing. If you get a card for 2%, then you're doing pretty good. But if you even look at them crossways, they raise the interest rate to 15%. Auto loans, you can get auto loans for 1-2% today. But if you have bad credit, you're going to be paying 15 to 18%. This makes a big dent in how much money you have left at the end of the month. And the same thing finally with insurance premiums. If you have lower credit scores, then you're going to pay higher insurance premiums. So there is a big reason why you want to pay attention to your credit scores and get those scores up. Get the scores up, your payments go down. In the mortgage industry, this is kind of how this works. I think this is kind of interesting. When you have a 740 FICO score, the interest rate that I can give you on a conventional loan there's no hits. You get the absolute best rates, depending on all the other things are equal. When you go to 739, so 1 point between 740 and 739, you get a small hit. Now, it usually doesn't make a big difference, but it's a small hit. But if you get to 719, which is still good credit, you get a little bit bigger hit. When you go down below 700, it's a much bigger hit. And then down here, the difference between a 679 and a 740, there's a pretty big difference between the interest rate this person would get for a conventional loan. If you go below 660, you're probably going with a whole different loan program that has a whole different criteria for how you qualify. So steps to take so you can increase your credit score 100 points. Well, the big one, and one of the things that mortgage companies, they don't want to see any late payments on any of the debts that you have for the last 12 months. But if you have past due accounts, pay them. You got to pay them right away. Get rid of all late payments. Have your credit limits increased if they're willing to increase your credit payments. And here's one that it's a strategy that's actually still valid today, is you can become an authorized user for somebody else that has a card that would be helpful to you. Now, this doesn't necessarily mean that you're going to be using somebody else's card. It just means that they have put you on their card as an authorized user. They may not have given you a card, but if they're using their card in the manner that we described, they have a high limit, they use low balances on it consistently, this could be a very good strategy. Finally, do not close old accounts. Keep them active. Use them from time to time. A lot of people get, they have a bunch of cards in their wallet and they never use them. Well, you need to use them every once in a while if you're looking to build your credit. Do this now. Pay all accounts that are past due. Pay past due accounts, and boy, if they're 1 day late, those are brutal. So try to avoid that if you can. They severely hurt your credit score. Pay past due accounts. Do not include judgments and collections. This is a whole separate thing. If you have judgments and collections, it's important that you talk to somebody like myself that understands how these things work. I encourage you to call me or somebody else that knows how these work. Have late payments removed. Now, this is a whole thing about credit restoration, and some of it's credit restoration. You can actually phone the creditor and request late payments to be removed. If you're persistent, and sometimes you're not going to have too much luck with the person that answers the phone originally, but if you work your way up the ladder to some supervisors, so every once in a while you'll get lucky and they will remove some negative markings on your credit. Always, whenever you're going to be paying down some debt and you're settling with people, always get a letter that documents that they're going to accept the amount that you're going to pay them that's less than the amount that's listed on the credit. You want to get their name, address, account number, specific late to be removed, and you want to get it on company letterhead signed by an employee. Now, this is another situation where if you haven't done this before, you may want to call me before you do it, because the people that you deal with collection accounts are pretty ruthless, and you want to be kind of careful with them. All right, tips. Every 6 months, request an increase to credit limit on credit accounts. If you pay the way I told you to earlier in this session, this will be very easy for them to grant that. Have the creditor base the increase on your payment history, your credit history. And then if creditor wants to pull, you don't need to do that. They don't need to lower or pull your credit to do that. They just need to look at your history. Ask a relative or a friend to add you to a credit account, making you an authorized user. Confirm the following items: current balance below 10% of limit with a good payment history. This is very important. No risk to, as a credit card goes to account holder. So again, this is all about being an authorized user. So confirm the following items. The current balance of the person that's going to let you be an authorized user is 10% of the limit, and they have a good payment history. It's no risk to them, as the credit card does not go to you. It goes to the account holder. You're just on there. Okay, keep all accounts open. Use old accounts periodically. Charge small amount. Pay off immediately. Closing accounts with a long credit history will hurt credit. When I say pay off immediately, I mean you might want to keep a small balance on there. It helps. This is about disputing. We're going to talk about that. That's confusing. Summary, do these things. Borrow when you don't need it. Keep your balance to limit ratio low. When creditor removes late and provides letter, use credit rescore. So this happens, and you won't be able to do a rescore, but I can, so call me when this happens. Consult with your mortgage professional before you consider paying off. I didn't spell that right, did I? Paying off a collection or judgment when applying for a mortgage loan. Increasing credit score by 10 points interest savings. $100,000 can make a big difference in the amount of interest that you pay. So how can you know if your credit scores can affect your life, or know how you're blah, blah, blah. This is my ending slide. I want to thank you. Hopefully this was, I went through that pretty fast. What time is it? Yeah, I really wanted to get to the credit card part tonight and share with you just how you can make a difference in your life, not only with just the potential to buy a house, but your payments can go down on your car, your payments can go down on your insurance, your payments can go down on your credit cards, and you'll just have more money to do the fun stuff that you want to do. So again, this is the way I'm going to end it. This is Mike Dura, the Kingwood Mortgage Guy. I'm going to answer questions here offline. I'm going to stop this recording, but I want to thank you for being on tonight. Hopefully this was helpful, and I will talk to you guys soon. Bye-bye. Do this. If you want to call me, you can call me at 281-348-9899.